I'll tell you the highest price per square foot that we've done is metal product and a
Wow.
lot more consistent too, because yeah, keep in mind, I mean, some of these are getting 16, 17, 18, 19 bucks plus net where, a lot of infills, barely 12, 13 or 14,
Yeah.
10, as well. Like we were looking at a project yesterday out here in the mid cities. It's at 10.
Why?
Well, it's a little bit of everything. That
Mhm.
tenant base that's in that infill, it's that established tenant base. That area is already built out. It already has that contractor tenant base that's servicing the area. It's not growing on the business side. Is to where when you go a little bit farther out and you got all that nice new home construction going on, you got sometimes higher end home values, you start to get that high payer tenant that you're not going to see so much out here. And so these guys are tailoring to a lot of the new construction, a lot of the new schools, everything of that nature. And so
This is a
it's not uncommon to
major distinction. I
see,
never, yeah.
yeah, it's not uncommon to see higher rental rates on.
Wow. We
Welcome to the Value Builder Podcast, where we focus on real estate with a value add mindset. Real strategies, real operators, real outcomes. Let's dive in.
Hey everyone, today in Value Builder, I joined with my partner Shea Lewis. We co-founded Industrial IQ, a premium data provider for small bay industrial investors and acquisitions. And today we're sitting down with Cody Payne, who in my opinion is the godfather for small bay flex industrial space. He closed over 10,000 transactions. He has been there over 20 years, wrote the book Flex Space Domination. And right now he built Flex Parks USA, a platform that connects small bay investors with the resources they need and expertise they need to acquire and develop these properties. So today we're going to be diving in what's happening right now in the space. You'll hear about deal activity compared to last year, where the rents are heading, where the vacancies are right now, where they're heading, whether developing is slowing down or still hot, what markets are slowing down or not. But most importantly, where the opportunities are still in this asset class in 2026 if you are trying to break in. So stick around to the end, because Cody dropped some serious insights that I did not know, and I learned a lot, and why self-storage investors are flooding into flex space, and what means for you and for the market. So let's get into it. Cody, welcome to the show. Thanks for joining. What's going on first quarter in Flex Bay Industrial? Let's see if we compare numbers or velocity of transaction compared to last year. There's a lot of noise going on. There's many opinions floating this year. But how do you compare this year to last year?
I'd say it's pretty similar. As far as the first quarter, we don't have the full first quarter numbers of all the investment sales across the U.S. yet. I can tell you from our standpoint, it's very similar. So I don't see a whole lot of change. I have seen and heard some change on the tenancy side and leasing side and whatnot. But as far as new construction goes and investment sales and transactions, those seem to still be holding very strong.
So let's lean in a little bit now. So my experience, let's say compared to last year, I think there was a pretty big gap. That was my experience. Is the offers were not sticking last year compared maybe to this year. It felt like sellers were not really adjusting to expanded cap rates. Do you see that this year buyers and sellers finally agreeing?
I mean, I think what helps it out is all the cross asset people that keep coming into it. Like we were talking
Mhm.
beforehand, all the storage guys coming over and whatnot. And so all that does is kind of help the buyer pool quite a bit. But I will tell you, I think maybe one of the things that you're running into, not sure, but with small bay and flex having so much popularity now, those sellers are really kind of feeling like they got a solid piece of gold. And so that's what's really making them hold on and push prices. That's one thing that people have been, and y'all probably been seeing, and I've been seeing too quite a bit is, you didn't have so much of that a long time ago. Like I'll tell you, when I first got started, people were like, just get it out of here. Just get rid of it. Please get it gone. And now people are like, I know what I got.
Yeah.
At night, I'm a big car guy, classic car guy. I like to peruse the Facebook marketplace and whatnot. It's always funny come across that guy that's got a 70s Monte Carlo and he wants like 25 grand for. He's like, I know what I got. And it's the same thing in the flex side. It's they all kind of hear that popularity, but when they hear that, if they're not super savvy on the market or not in the transactions every day, they just sometimes can have a overinflated value of it. And look, yeah, everybody's proud of their property, and you should be.
Yeah.
But that's one thing that we've been running into a lot more lately.
The product that you're selling, are you selling mostly stabilized or are you selling mostly value add? What's your split in those two?
probably it's probably 70% stabilized. Just because small bay industrial parks are doing so well, it's really hard for them. The only ones that you'll really find value at is maybe with the older ownerships that just haven't pushed rents, and so we do come across those quite a bit. Uh, but there's a lot of stabilized product out there, just because the tenant velocity and whatnot still remains pretty strong
Yeah.
throughout the U.S.
Yeah. So, question just to dig in on that further. So, Saul and I like to buy value add stuff. I'm young and poor and I'm trying to, build the balance sheet basically. So, value adds the way. But your buyers, if you're selling 70% of your deals or stabilized stuff, like who's the buyer profile? Is it, I
Yeah.
know you have this 1031 program that you have, but like who's the buyer profile that's coming in and actually buying this stabilized asset?
Some of your best people, and if you don't include like, the institutions that buy infill stuff, right? They'll buy stabilized infill. But some of the main people are going to be, there's a lot of private equity out there for it. There's quite a few real estate funds that have been built for it and continuously be created and built for it. And then there's also just a lot of private investors that don't want to take the risk on new development and rather just buy something that's already there.
Hmm.
So let's say compare if you try to put like Paul's know how it's changing that from small investors to institutional. I mean, is it like rapid institutionalizing, or it's still private smaller size investors?
So the infill product in major metros, that's going to be fought between institutions for the most part nowadays. But your largest buyer pool is going to be made up of private equity, real estate funds, syndicators, people like that. That's your biggest buyer pool.
Hmm.
And they're not always as competitive on the infill stuff, but as you know, every market has, a lot of metal construction, a lot of, secondary, tertiary market construction and product. And so those guys are really just kind of, running all across every state, looking for stuff. And I think it's a matter of time before the institutions start to expand their profile. It'll inevitably happen. It always does. But it's still taking a little bit of time for them to do it. And it's just because it's so much easier to have that scale on the
Hmm.
infill side and keep it close together.
I have a question regarding these more stabilized buyers. And obviously, you have the institutional buyers and more infill, but then private buyers, let's just say smaller PE shops that are buying your stabilized product, maybe in a little bit more tertiary markets. What's the tenant base that a institutional buyer in your infill versus your stabilized park, maybe on the outskirts of town? How does that differ in the tenant base? Like, what's a hard no? If people are listening to this and they're like, all right, what do I want to fill my part? I just got a new value add deal. What do I want to fill it with? Like, is it super important to have a certain tenant mix? That's what I kind of want to tease out.
Yeah, yeah. So, not all of them, but most institutions try to stay away from, heavy automotive, right? So do a lot of private equity and people like that. In certain states that have heavy CBD presence, they obviously want to stay away from that as well. But as far as a lot of the tenant base in infill product, I mean, it's going to be a lot of times your typical contractor-based tenant. So, not super high grade credit, just really because that's how I started my career. I was leasing, infill small bay. But when you start to travel, even still in the same metro, but just a little farther out, you start to get into a lot of times the newer construction metal and whatnot. A lot of those you will see a lot more diverse tenant base, not just the not just the the contractors, plumbers, electricians, people like that. You'll start to see a lot more fitness studios, even some office tenants in there, sports related training facilities. So they do get, I think, quite a bit more diverse in the newer construction metal parks, and it's a lot of times because the infill stuff is older, traditionally does have lower ceilings, and also in the infill, I can tell you that tenant base doesn't really grow very much. It's
Hmm.
really just fighting amongst the same tenants in the area. Those guys just kind of move around. I can't tell you how many people we moved around that was the same exact tenant, just
Yep.
moving them from building to building to building to get, the lowest cost product. And so that's why I like the higher end, nicer metal, newer construction in high growth areas. I think those have a very good, strong trajectory, and you're dealing with business growth more than fighting amongst the same people, in my opinion.
Yeah.
All right, so I want to follow up on that on the metal, and I we briefly spoke about it, but I think in industry is two school of thoughts that if you buy metal, your exit to the buyers much smaller. Institutionals are not going to buy it, but I feel actually it's not true anymore, right? Institutional buyers they will buy metal buildings, and it's no more longer a stigma anymore, right?
Yeah, I'll tell you the highest price per square foot that we've done is metal product, and a lot more consistent too. Because I mean, you gotta keep in mind, I mean, some of these are getting, 16, 17, 18, 19 bucks plus net is to where, a lot of infills, barely trying to get 12, 13, or 14,
Yeah.
10, as well. Like we were looking at a project yesterday out here in the mid cities, it's at 10. And so,
Why?
but like, it's because, well, it's a little bit of everything, but that tenant base that's in that infill, I mean, it's that established tenant base. That area is already built out. It already has that contractor, that tenant base that's servicing the area. It's not a lot of growing on the business side. It's to where when you go a little bit farther out and you got all that nice new home construction going on, you got,
Oh,
sometimes higher end home values, you start to get that high payer tenant that you're not going to see so much out here. And so, these guys are tailoring to a lot of the new construction, a lot of the new schools. I mean, everything of that nature. And so
this is a
it's not
major
uncommon to
major
see,
distinction.
yeah, it's not uncommon to see higher rental rates on
Wow,
outer
we had
markets.
so many conversations about it. I never caught this way, but I understand right now because you're pretty much jumping in a new demand and you pretty much almost like establish a new rate where you when an infill, you have the rate where it is because that's the existing tenant base. Never knew that. That's a great
Yeah.
distinction.
And a lot of the infill stuff is leased by third party brokerage firms,
Hmm.
right? Like our firm and all
Yep.
the big real estate firms. And so you do have a lot of times a lot more TIs and commission structures and the infill stuff as well. So it does affect your bottom line a little bit more than we see on stuff in growing markets that still I consider somewhat infill. It's just not deep in the heart of Dallas. It's maybe on one of the sub cities just outside of
Yep.
it.
Yeah. All right. So on that, like, all right, so for your brokerage business, when you're going to sell a park or maybe you're advising on a buy, what tools are you using for like finding the new construction count? Because it seems like new construction comes out. I mean, housing. That's what I'm talking about. New supply of housing comes on the market. Maybe you have a supply vacuum, like there's just no supply in that immediate area. What are you tracking for housing starts or how many houses are being developed in that area or rooftops being developed? Like what tools do you use to inform a buyer on your feasibility study or something like that?
Yeah, so as far as the small bay feasibility, they use several tools, whether it's Qubit, ArcGIS, or something of that nature. A lot of times they will do general research as well to figure out, because I know they were working on a project out in Little Elm, and not a whole lot was coming up, but they just did a lot of local research to find there's 1,400 homes being built by X developer, another 900 homes by X developer. And so some of that stuff still does take a little bit of manual research. Obviously, you can get a little bit of help through, Claude or
Yeah,
chat GPT to help find some of that stuff. Yeah, that's a lot of the tools that they use to find the new home construction.
great.
Because a lot of your typical stats that you'll find as far as growth patterns, to be honest with you, I think in many cases are off. I'm not saying like CoStar, LoopNet, or any of these guys are off, but sometimes you'll look at some of these on some of these sites and it'll show 5% today, but 2% over the next 2 years.
Hmm.
You kind of wonder how that makes sense. And so really it's just finding, all right, how many homes have been built year over year over year, and that'll give you a better indication of that number. But yeah, I leave that to the research guys, the small bay feasibility. That stuff doesn't really entertain me too much.
Yeah. Oh, we need to include the rooftops into IQ. Yeah, you're giving me
Yeah.
ideas here, Cody.
Yeah,
That's
for sure.
big. It's real big. Rooftops, home values, spending per capita is really good too, because that's really going to help you harness how much rental rate you're going to get.
Do you have a rule of thumb on that?
So traditionally, if you're under 10,500 spending per capita, it's gonna be really hard to get rates or above 13, 14 bucks a foot in a lot of
We're
cases.
talking triple net, right? Makes sense. Now, one more thing I want to lean back about metal to infill. I know you sell all over the country, but I think focus in Texas. Do you see the same thing also in other parts of the country where, call it maybe Midwest or East doesn't have enough expandability to go outside, but meaning the same trends that, in outskirts or further away, metal product actually getting higher rates than infill product? Do you see that in the markets too, or that's Texas phenomenon?
No, I mean, it's going to be very niche specific, but I mean, there are a lot of markets, like in the Carolinas and in Georgia and Tennessee. I mean, there's a lot of areas out there in Utah and Montana. I mean, there's a lot of areas that are, seeing those kind of growth pockets and are, expanding metros and just continuously expanding outward. I think there's a lot of opportunity for that. And look, most of the new construction is metal construction because, it's cheaper, it's quicker, it's a lot friendlier and easier for a lot of these new developers to come in and do, and they kind of can get it and understand it a little bit better. And then you got all your storage guys that, traditionally build out of metal anyways. But as far as the metal goes, I mean, it's very state and market specific because, I mean, there are areas that are, oversaturated on their way to saturation or just don't have that rental rate demand to, pay for the new product anyways.
Makes sense. Yeah. And the buildings became really nice in the last 5 years, right? Municipalities
Yeah.
accepting them. It used to be
They're
like
basically
you can't even
retail.
go in a meeting, but right now, I
Yeah,
mean, they're
no, they got a
definitely much
lot of nice
nicer.
glass
So they're now
storefront on them,
accepting
and
it.
yeah,
Yes. Yeah.
yeah,
What we call
they
the
look much better.
retail-esque product.
Yes. Yeah.
Yeah, people used to just call them pole barn. They're like, I don't want any of those pole barns, and so, but
Hmm.
yeah, they're much nicer now.
Every week, I read hundreds of commercial real estate articles from across the US and around the world. I connect the signals, break down the Fed moves, and share real case studies, not theory, from my 2 decades of real estate experience and actively doing deals right now. My team and I spend 15 plus hours on a weekly basis and deliver this to you for free. You can read it in 5 minutes. So every Sunday at 9:07 a.m., you'll get major commercial real estate news that matters, one Fed insights that matters, one deep dive case study from me or one of our operators who already made the mistakes, so you don't have to. Thousands of commercial real estate operators and investors read this newsletter, especially in the value add space. And don't take my word for it. Check out hundreds of reader testimonials online. Plus, when you subscribe, you get instant access to a Proforma underwriting tool, the same one we use every single day to underwrite value add deals. Now, this is not for you if you're looking to get rich quick schemes, or if you're looking for theory and hallucinations, not real numbers, or you're not serious about commercial real estate. But if you want real tactics, real deals, real results, no bait and switch, go to joinvaluebuilder.com and subscribe for free. And see you there, guys. Yeah. All right, I would like to lean in right now in rents and rent growth. And what do you see, guys? I probably can start from us that in our underwriting, actually, most in where we buy, I right now don't underwrite rent growth in most markets, just almost like I'm doing flat, just getting them to market. But that's about it, at least for the time being. When I have the sense that what's going on in near future. Cody, what do you see in next year or two? And do you still underwrite rent growth in most markets? How do you see that right now?
So I think your stance is good. Your stance is, to be honest with you, the stance that I would take if it's something that I'm investing in. I'm not accounting for a whole lot of rent growth. The years and days of people putting in 5%, I think are kind of
Mm-hmm.
stalled right now, as they should be. There's still a lot of markets that are still seeing good rent growth though. 3%. Some are still doing better, but it's very market to market to market. If you're stabilized and you're going into something stabilized, obviously if it's value add, that's gonna be a different thing. But if it's stabilized, I mean, I'd put very little in there if it were me, and just kind of keep operating as status quo, unless you're in a area that's just, you're in a very tight spot and you're kind of the only product out there. That's when you can maybe command a little bit more. But like I said, it's very market dependent because I mean, there's several markets, even in Texas. Texas is metal building mecca out here. Every metro just has metal buildings going up everywhere, but there's plenty of markets out here where rates have actually gone backwards. And so that's why kind of understanding those rental rates and how they've changed. And if if they're not, increasing like this and have just kind of flatlined, that tells you that the demand has been met
Mhm.
and they're just struggling to keep those, vacancies, under a certain amount of time.
Yeah.
Do you see with this niche happening similar to what was with self-storage, that what it was overbuilt 2022, 23, that was the drop in rates? Do you see something similar happening in this? I think it's a little more difficult in terms of construction to overbuild that fast, but it's, I don't know, what's your take on it?
No, I think it can. I think the unique thing about it is a lot of the stuff that is struggling on the rental rate is the really, really basic, efficient product, right? Like just super basic metal, no glass insert, no amenities, no nothing, just a really basic product. Those are the ones that do see the struggle the most and the fastest because it's the most easily replicatable. So
Mm,
that is kind of like the storage model, right? Because the reason that storage kind of struggles a little bit is because a 10 by 10, like if you're moving and you're looking for a 10 by 10 unit, you're just going to go to the cheapest one that's
exactly.
closest by, right? And so it's no different with flex. If you're building something that's too basic, you're going to put yourself in that category. And so that's why we tell people, look, if you're building,
Hmm.
if you're not building it doesn't have to be super high scale, right? But if you're not building something that has some type of amenities or something that is different than anybody else that's going to come in, because almost 80% of it is that really basic efficient build that's being built. So all you
Hmm.
got to do is build something slightly nicer and you'll always be ahead of those guys. And a lot of people pay for quality, a lot of people pay for frontage and location, and so if you do that, you will be ahead. But we do see it with the more basic stuff, as you should, because of how easily it is to replicate.
Mhm.
So what are those amenities, the most effective amenities that's called in a an apartment complex for businesses? What are those main amenities you think that moves the needle actually?
The best one's location, in my opinion. Some people don't
Hmm.
consider that an amenity, but as you know, everybody skips out on location. They'll buy off the beaten path instead of being on the beaten path. Ceiling heights, mezzanine, glass entry, parking, rear storage yards. I mean, those are all really key things that a lot of people don't do. And, you want to figure out what's in the market, what does the market have, and then how do I elevate myself above it? And sometimes, because you got to keep in mind, especially out here, you got so much of the market that is 16 feet and under, so they can't have mezzanine space. Those e-commerce guys can't stack to the brim. And so you build something that's a little bit taller, that's going to help you out. You build something with maybe a little bit better frontage, more parking, because all these parks are underparked anyways. And so that can be a struggle for certain tenants to be able to come in. But those are going to be my top amenities that I like.
What about power? When you're deal, obviously a hot market, it can be overlooked. But like when you're selling a deal, what do your buyers love when they come across it from a power perspective? Is it three-phase to every single unit? What is the power that people want?
I mean, some people, and that's a good question, Shay. It's very rare that a 1,500 or 2,000 square foot unit, if it has three phase, it's very rare that they'll ever use it,
Yeah.
right? I mean, you got to be running a washateria in there or something
The
to
complete guy with like a massive machine. Yeah.
Oh yeah, and so because we've seen people have machine shops and the basic 200 amp panel or whatever, and so the three phase I think can be good, but it's not huge, and it's very rare because I mean even when I leased and even our leasing guys here, it's very rare that they ever get a tenant that goes I have to have three phase
Hmm. Hmm.
because they're not cranking that much power at 1,500 1,800 square feet.
Yeah. All right. So for disposition, what's the clear height that people should be building to?
18,
18,
18 feet.
18 and above. When
18
I
minimum,
get
yeah.
this, Saul and I are buying a deal right now. We close on May 6th. Uh, it's 30-foot clear height.
Oh, that's beautiful.
Tilted concrete.
That's beautiful. Yeah.
Yeah.
Crazy.
You don't see that. You don't see that very often at all. But no, I like that because, it allows all these people. I mean, there's so much more stuff you can do with it. 30 feet, I will tell you, if someone's going to AC the whole thing, it's going to run a bill up. But there's so much more you can do with it. I mean, people can do second floor office space. I mean, I was at a park out there in Magnolia and they had, I think it was like 28 feet and they had a really nice high end gym and they made a full mezzanine second floor to have their cycling classes and all that stuff up
Mm.
there. And I mean, it was real nice. And they could not have done that without that ceiling height. And they were paying a very pretty penny in rent too.
Hmm.
So let's say on those type of mezzanine improvements, what you see, do you see that tenants pay themselves, or that's rolled in TI package from developers? Those extra mezzanine and second floors and stuff like that. What's the predominantly?
So you have some developers that will just offer it and then charge more in rent. And so
Hmm.
they're basically recollecting the cost back.
Hmm.
Sometimes tenants will pay for it. It really depends on your structure. I like keeping stuff as basic as possible, but offering certain things, right?
Hmm.
And so if you're going to offer it, it's like, hey, look, we can put this mezzanine in, but it's going to be an extra X number a month. And you're
Hmm.
doing that to get your costs back. And also another good way is to finance it to the tenant. And so if they want additional finish out, that's probably the way that I like the most because when you finance it to them, which is almost the same way as you building it into the rate, the only difference is it feels like it's coming out of their pocket a little more directly. So it'll make them probably have a little bit higher renewal probability on that space. Is if you're like, look, you want a mezzanine space? It's just say it's 5 grand, 10 grand, whatever, but I'm going to finance it to you, and we'll build into the rate. It just makes them feel like they're actually paying for it instead of like, oh, you want mezzanine space? It's now 12.50 a foot instead of 11 a foot. So we like that route a little bit better because it makes them feel like it's their money, and nobody wants to lose their money.
Yeah.
Well, that's a great tip. How do you see the developers if they're not loading or reloading the senior debt when they're doing those packages? If they're financing that outside, how is that being financed with the same bank, with with additional bank who finances the lease?
I mean, as far as like, so if somebody's got new construction and their project's now done and they're looking to refi. I mean, in many cases, they're going back with that same bank unless they went and got some type of, bridge loan or construction loan from a third party guy that's all they do. But a lot of times they're refinancing with the current lender. It's usually the easiest to do.
Yeah, but let's say if you have 20 tenants, 10 of them are doing different projects. Do you think I thought maybe they see there is some financial instrument just not to go through whole refinancing, just pull as you go through different tenants. Maybe it's not. Maybe I'm just overthinking. Probably it's the only way to do it. Just refinance the whole thing.
I keep things simple. I've got a high school education.
Yeah,
If I don't have to think too much, that's going to help me out. I mean, as far as like I said, anybody doing new construction, when it comes time to refinance, a lot of times they're sticking with their current lender and getting it refinanced. That makes the most sense, unless obviously you go third party broker and get somebody to help beat a rate down, but then you're restarting the loan process.
exactly.
All right, I got a question. So you mentioned that sports court that they built on a mezzanine. When you sell that building, are you selling that as a part of square footage to the buyer?
No, no. But to be
In-
honest with you, we don't. And just because we kind of consider a lot of that stuff removable and whatnot and not permanent square footage. But to be honest with you, I don't think it would really matter if we did or didn't because they're getting the higher rental rate.
Yeah.
And so people are buying these on a rate of return anyways. Just by adding that square footage, it maybe makes the price per square foot look a little less. But your most savvy buyers are not going to count that. And so I know some people do, some people don't. I don't. Me personally, I don't count mezzanine space as additional square footage.
Yeah. I think in a hot market, people probably do, and in a cool market.
Oh, people do it all the time,
Yeah.
and owners ask us to do it all the time. And like I said, if I'm personally looking at it, I don't count it as additional square footage.
All right. I think let's talk about Flex Parks USA. So many of our listeners would benefit if you can just tell what you do, what you can do for them. Just can we talk about it a little bit?
Yeah, man, I'd love to. That's what I do for a living.
Yeah. So
So
tell me tell me, what, we obviously know that you're selling a lot of parks, but there is more to that you provide, that you offer to the industry. What is?
there's a lot more on our dating profile than the initial picture. And so we do a lot of site analysis work across the US. So if someone's looking at a site or looking at a piece of land and they're like, I'm just not sure if a park can work here or what type or what, size of units I should do, we can do an analysis on that to help, determine the area's viability, right? You want to make sure something's not on its way to saturation, or you want to still make sure that demand is there. So we can take that, we can gauge that. We look at all the business metrics, businesses coming in, how many that increases, what these businesses can pay. And so we can help determine, all right, this market you know, has opportunity to build here, and here's your competition subset. Here's how you can diversify yourself. So we do the market feasibility. That's a big thing. We do that all across the US and Canada. So we do that, and we do the investment sales as well. So, we're kind of at the beginning and at the end, and we let you mess around in the middle. But obviously, if anybody needs, construction contacts or anything like that, I mean, we deal with a lot of these people all across the US. So we've always got really good people that we know that are, good quality builders, engineers, architects, designers, things of that nature. But we don't deal in any of that. We're on the site selection and the investment sale. And then also, if someone's looking at something and they need some equity, we have the ability to bring that as well.
That's awesome. Yeah, one question is on my mind is self-storage industry. I've seen a lot of talks that the folks who are buying self-storage, they getting in this industry. Do you think, I mean, do you see the same thing? And um, I guess the similar question: are we getting in a similar situation like it was a self storage that there are going to be so many people who get in next 2 years? Yeah, it's going to get overheated and it's going to be not so sexy like it was the last 3 years in this industry.
Look, either way, whatever it is, it's going to work out, I think, just fine for me and our guys. But I mean, I will tell you this: there's a lot of people coming from the self storage because it's a fairly easy, natural progression on the build side,
Hmm.
right? If they've got the self storage build background, they're going to be able to do this with relative ease. So you are going to see a lot more of that. You're already seeing quite a bit of it. You're seeing a lot of crossover. I will tell you, there's not as much. Everybody always calls and they're like, man, it just seems like everybody's trying to build this. I will tell you, less than 5% are probably actually building. I can't tell you how many people call us and go, hey, we got a piece of land we bought, we were going to
Hmm.
build, we did all the site engineering on
Yeah.
it, but it's just too much money. Can you sell the land? And I mean, we get those calls all the time. And so there's a lot of buzz out there, but not as much being built as people think. But there is a lot being built. I don't
Hmm.
think the storage guys are going to oversaturate the market. They may oversaturate the efficient build market because that's what
Hmm.
most of them are building. But I mean, look, there's a lot of we're dealing with people from the office asset class and the multifamily asset class. And so that's why it's so important that if you are building or investing to really hone in on the area and try to figure out what the current competition, what the future competition, because that's the best thing about these small bay industrial parks is like Shay was saying earlier. I mean, they look so much better. Like metal construction looks 100 times better now than it used to.
Yeah.
And so
Exactly.
you can really diversify these things. And so that's what we really preach on because I'll tell you my favorite thing to sell is a beautiful metal park with a lot of, glass frontage, awnings, good parking, high ceilings. I mean, with a good diverse tenant mix of showroom guys, maybe a basketball training facility and things of that nature. Like those are our favorite because, those kind of buildings can tailor to a really wide array of tenants.
Mhm.
Hmm.
And so, but no, I'm not too worried about the storage guys. The storage side will come back. Someone will diversify into this, but that's why we go to the storage conferences. I was in Vegas last week at the storage conference, and I'm telling you, just walking around with the Flex Parks USA polo, everybody was stopping us like, "Hey, we want to get in it. Hey, how do we do it?" And this and that.
That's
But
awesome.
but like I said, that's what I'm saying. Like an industrial IQ booth would actually probably do pretty well there.
Okay.
When is the next big self storage conference?
So there's two more coming up. I'll send them to you. There's one called The Show, and that's in Atlanta. And then there's another one in Vegas later this year that I may be at. I'll send you that one as well.
Yeah, we need to go, Shay.
Yeah.
At
Well,
least
we'll
one of
definitely
them
know. What we're working on,
for sure.
just what I think is interesting and dovetails into this, like, hey, are we overdeveloping? Are we underdeveloping? Like, where's this wave? And I don't want to buy, in front of a freight train if there's a bunch of supply coming on the market. So what we'll have in the next couple of weeks inside of Industrial IQ will be all the development pipeline that is planned and permitted across the country. So we'll be able to actually see if you just log in, you'll be able to see like, all right, I got a guy who's sniffing around over here in a planning stage, but this one's actually permitted. Like I'm going to probably go, I want to stay away from that or go find another pocket that has a vacuum that I can go fill to AKA build product and set my own rates.
One thing that would probably be good too, and I'm not telling you how to run your business,
Please,
but I
all
mean,
ears.
why not? Why not? We've got a grading system that we use here. Why not apply a grading system on it too, so that way anybody that's looking in a specific area can see that it mostly has, projects at 60 points and nobody at 80 points or something like that. I think that would also be good because, as we talk about this, I mean, these things can just look and be, so commanding. And those grading points, have a lot of things on it between location, quality, and things of that nature.
Great idea. I think it's
I
an
think it's a
amazing
really
idea.
good idea. So the mechanics of that would be we would go through and we'd grade each property that's in that area, like based on whatever your scale of, hey, location,
Yeah.
height, doors, docks, office percentage.
Well, I think he has in mind about an
We've got a
area.
checkbox. Yeah, we've got a checkbox that we use. If it's traffic, if the traffic counts exceed this, it gets a 1 through 10. The build quality is this, it gets a 1 through 10. If any amenities in there, it gets a 1 through 10. Ceiling heights 1 through 10. And so you do all that, and then it just adds it up and gives you a number.
That's awesome. That's amazing. All right. We're almost at the top of an hour. Cody, if folks want to find you, where can they find you? how can you go on the Flex Parts USA or email? Just give us the best contact, for you to get in touch with you or your team.
That's right. We're the easiest to find. You don't got to send Liam Neeson after us. Just flexbusinessparks.com. We'll take you there. We got the team there. We got a lot of good info there, and anything you need, we'll get you taken care of.
Cool. Cool.
This is great. Hey, this was awesome. I learned a lot. I'm pretty sure listeners learned a lot as well. I would like to do another one in a few months. It's always fun to chat with you. You're just wealth of knowledge, and I really appreciate you jumping on the show.
No, I appreciate you having me.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.